Matthew Johnson's with us, president and owner, Johnson Wealth and Income Management. Thanks for being with us. So as I'm talking to some of the traders, they're really expecting a lot of choppiness going forward. What do you say here after a couple of weeks of gains, but you see the S&P 39.94 back below 4,000?
Thanks for having me on, Nicole. Yeah, I really have to say that I'm going to repeat a lot of what's already been said, which is the fact we are going to see a lot of choppiness as we're digesting all of this information and just trying to make the best sense we can of it. You know, the Federal Reserve is hoping to see employment go down. They're hoping to see wages not nearly as strong. And yet we come out with a report that shows us, oh my goodness, we got 263,000 jobs added. We've got stronger wages that take place. And all of that leads us to this uncertainty of whether or not the Feds are going to actually come through with a 50 basis increase. I really think that they will, but it's going to be a very long grind. And as I've said before, we've got to be extremely careful as investors in today's market of these little rallies of optimism that we see, because we can be optimistic all we want, but the Feds at the end of the day still have a job to do. And it's going to take them raising interest rates in order to make that actually happen.
And do you feel that, you know, I've heard a couple of different sides of this. Is the big risk if they do too much, or the big risk if they don't do enough?
Well, I would tend to say that there's probably a much broader risk if they do too much. You know, they were doing 75 basis points and felt as though they were just going to be doing them simultaneously. They weren't going to take a break, and now they're backing off just a little bit. And they're coming out, they're translating that information to us and saying that that is their hope that they can. And then they'll finally halt some to see, you know, if that terminal rate has actually been met and they're getting the results that they want. But I would rather see them go about slowly increasing the interest rates than take too rapid of a pace, take too much of a bite. I understand early on they were trying to compensate for the momentum of the economy. But I think that things are starting to go in their direction. They just have to give it time and give it some patience, and things will continue to shake out and they'll abate.
Right, understood. So at this point, what do you tell, you know, investors or how they're feeling? Because I think there's, you know, the one camp where some people are feeling good, but I mean, there is a lot of nervousness too.
Oh, absolutely. You know, it could be looked upon taking place from Thanksgiving until, you know, Cyber Monday. There was over 80 million transactions that took place. We saw a tremendous amount of sales that took place, which was really helpful to a lot of retail businesses trying to unload a lot of overstocked inventory. And of course, we all love a sale. We all love a clearance. And if things are going to be costing us more, we want to take advantage of that. And boy, the American shopper certainly did that over the course of the last week or so. But in reality, as a fixed income guy, I think it is extremely important to be looking at good quality fixed income instruments. If you look at the longer duration type instruments, you want to be able to lock yourself into some of those better interest rates at 5, 6, 7%, if at all possible, making certain that if you are going to go the direction of equities, that you're just simply nibbling. I don't think it's a time to get greedy at this point, because we're going to see more volatility ahead. I think reality is going to settle into the market once the interest rates do go up in December. I think that there's going to be a lot more data that's going to indicate we're slowing down, but it's kind of this tug of war between an economy that's still, you know, fairly strong. We've got the holiday seasons that are really promoting a lot of sales right now, but at the same time, we've got this inflation factor trying to bring it down. So be extremely cautious and look for dividends and strong yields.
Yeah, and you said a lot of stores are promoting and putting sales, and in your notes you talked a lot about the credit card companies, and we know that consumers are using a lot of credit cards and buy now, pay later. And so tell me a little bit about the consumer side of this for the holiday season and the business side.
Well, I think it's shown in the behavior of the average family that are going out, they're spending and they're buying for Christmas at this point. They're not silly. They understand that there's pressures coming to their own household. They understand that, you know, they may not have strong bonuses or pay raises. They understand that they're just glad to have their job. They know that things are costing them more. And so what are they going to do? They still want to be able to participate. They want to give their gifts, but they're thinking, okay, I can't really afford this, or I don't want to afford this. I tell you what, I'm just going to buy now. I'm going to pay later. And then it'll give me a little bit of breathing room to be able to determine how I'm going to pay for it. Maybe I can pay less. Well, we have to be extremely careful of that. Credit card companies are like the circling vultures right now with interest rates going up. This is their claim to fame. And we're seeing average interest rates now at about 18.5% on existing cards. If you're a brand new person who's getting into credit cards, you could be seeing interest rates as high as 22+%. But this is going to be scary because we know that there's always going to be a point in the future in which we're going to have to pay for these things. And that high interest rate these families are in is only going to exacerbate the pain, I'm afraid, in the future. So we have to be extremely careful to look at what is going to happen with defaults and things of that nature with these credit card companies and buy now, pay later companies.
And you said stagflation will be the buzzword of 2023. Describe what that means and what that means for investors, too.
Well, stagflation is basically where things have kind of ground to a halt. It's not necessarily that they're just on an utter descent and things are going south very, very quickly. And there's a lot of, bleeding taking place on the market and with companies. But the reality is, I think that we're not going to see any growth. We're going to see things slow down. And we're just simply going to be looking at a very blah-looking market. There's not going to be very many shiny spots for us to pick out and go, oh, now that's an explicit winner. I think we're going to find a lot of subdued profitability with corporations. Things are going to slow down. I do anticipate that we're going to see some decline in CPI coming out a little bit later, but I think it's going to be very, very sticky. And that's going to just only lead more fuel to the fire for the Feds to continue to do what they've been doing and slow this economy down.
I look forward to speaking again in the new year, and we'll see where we stand, particularly after the Fed raises in December, and then we'll get some more data. Matthew Johnson, nice to see you, President, owner of Johnson Wealth and Income Management.